After understanding macroeconomic conditions, let's have a look on company's financials. Financials of company consists of these four terminologies: income statement, balance sheet, cash flow statement, and unit economics. Income statement is the statement that shows revenue and expenses of company in specific time period. It is further divided into following sections. Revenue is amount of money that company earned, interest income is earned in interest from lending activity, and lastly, fee income, which you can say it's adjacent income, counted in revenue. Next section is interest expense, that company lends out to its customers. When there is possibility that loan isn't recovered, then some amount is accounted as loan loss provisions and some payment processor and operating expenses. We calculate net financial income by taking total financial expense from revenue, then we find net income by deducting taxes from these expenses. Second terminology is balance sheet, which shows company's assets, liabilities and shareholders' equity. It tells us about financial position of company. Let's discuss its parts. Asset is an item of value that company owned, and company expect future benefit from it. Asset may be in form of cash or bonds, loans, and advances. Liabilities is a sum of money that company owns, which is made up of borrowings, payables, and miscellaneous liabilities. Lastly, the shareholders' equity represents the claim on assets that shareholders have after company's debt are paid. Total assets of company should be equals to sum of liability and equity. Third section is cash flow statement. It is financial statement that summarize the in and out of cash from company in particular time. Operating cash flow is that cash which entered in out of company on regular business activity. Firstly, the net income of business adds non-cash expenses, then any increase in assets, for example increase in loan, is subtracted. Then adds any increase in liabilities. Investing cash flow is the money that entered in out from company, as a function of company investing in or disposing long-term asset. Lastly, financing cash flow is money that indicates the company's finances activity as in and outflow of money. This is made up of change in borrowing, equity issuances and dividend paids. The last section is unit economics. It tells us how much company earned or lost on each loan. It consists of average loan and interest revenue including cost of borrowing, and we get net financial revenue per loan. Then we understand costs. First cost is cost of default when company can't pay loan back. Next cost is customer acquisition costs, which is used to acquire a customer. Eventually, loan of servicing cost. By all this we can calculate company's margin per loan. We always look for positive unit economics. Evaluating the portfolio. A loan portfolio is a record of loan that a lender owed. We have to understand these questions. How the portfolio grown over the time, and how the portfolio has performed over the time. We can answer these by looking at entire portfolio, which is called aggregate, and second is cohort basis, that is analyzing the portfolio by grouping loan together. In aggregate portfolio, we acknowledge change in size of portfolio and change in number of loans over time. With this data we create this chart. After this, we understand about earning and risk of portfolio. Performance charts can be made up as: we analyze the portfolio by grouping loans together, and this is called cohort analysis. Similarly, we have to understand these given 2 points about growth. Total size of monthly originations over the time. Total number of monthly originations over the time. Lastly, we know about portfolio performance in cohort analysis. The graph of monthly portfolio risk is this. The graph of average interest earned can be given as